Welcome to The Explainer. Today, we're literally tearing down the biggest, thickest wall in real estate right now, the excuse of the empty pocket. You know, every single day, savvy investors are grabbing massive properties with absolutely zero down. No piles of cash, no secret trust funds, just highly structured financial leverage. So, let's jump right in and break down the exact mechanics of how they actually pull this off.
Okay, here's the hard truth, and it might sting a little. The banks, they lied to you. That golden rule about needing a 20% down payment, complete myth. It's basically a gatekeeping metric designed to keep you renting while you try to save up for decades. But insiders, they bypass this system entirely. Seriously, if you have no money, you just buy the house anyway. You do it by completely rewriting the rules.
We're essentially looking at a tale of two completely different economic realities here. On one side, you've got the traditional bank loan, and man, it is incredibly slow. It's restrictive, it demands your liquid cash, and it heavily judges your financial past. But on the other side, 100% owner financing, it is highly agile. The seller literally becomes the bank. There's absolutely zero red tape, no rigid debt-to-income algorithms. It's all about speed and direct negotiation over clunky corporate bureaucracy.
Okay, let's dive into this. And just to be clear, these aren't some shady internet loopholes we're talking about. We're pulling this data directly from the documented playbook of real estate expert Susan Smith Alvis. Her work details exactly how these specific transactions are legally contracted, no matter what the market conditions are doing. This is a real look at the precise architecture the wealthy use to orchestrate deals. They aren't using pennies, right? They're using legally binding paper.
So let's analyze the first mechanism. It's called the wraparound mortgage, and it completely defies traditional financial logic. I mean, usually common sense tells you that you have to pay off an old loan to get a new one, right? Well, not here. In this specific structural flow, the seller keeps their original, older debt completely active. Then they literally wrap your brand new debt right around it. So you aren't bringing bags of cash to the closing table, you're just bringing a legally binding promise to pay. And this brilliantly illustrates the actual flow of money in this engine. Let's use a simple example. Step 1. The seller keeps making their old mortgage payment at, let's say, a 4% interest rate. Step 2. They finance your purchase directly. Step 3. You pay the seller at a slightly higher interest rate, maybe 6%. And Step 4. The seller just pockets that 2% interest spread. They're generating continuous cash flow on money they don't even possess. And you get the keys without draining your capital. It is just pure financial leverage. Now, listen to this quote. I buy houses all over the country and pay cash. Then I turn around and rent to own. That is a documented, real-world strategy from an elite investor. They deploy their capital to acquire the asset, and then they use lease options to extract massive premiums from buyers who lack upfront cash. It's a ruthless but effective economic model built entirely on maintaining control, dictating the terms, and totally mitigating their own risk.
So how does that actually work? Well, the lease-to-own formula is essentially a mechanical algorithm. It runs on 4 exact sequential steps. 1. You write a very strict contract. 2. You pay a monthly lease plus an additional premium that supposedly builds your equity. 3. You wait out the 2 to 5 year term of the agreement. And 4. You execute the option and secure standard bank financing to buy it outright. It's highly calculated, and mathematically, it gets you in the door today.
But here is the catch, and it is a brutal reality check. This system heavily favors the seller. If you reach the end of that lease term and you, for whatever reason, cannot execute the option to buy, you lose absolutely everything. Every single dime of that extra equity premium you paid vanishes directly into the seller's pocket. You walk away with completely empty hands, while the investor gets to keep both the accumulated cash and the underlying asset. Ouch.
Now, what's really interesting about this is the logic behind these deals. You have to logically ask yourself, what is the incentive here? Why would a seller ever agree to bypass the banking system? I mean, they certainly don't do it for charity, right? They do it for speed, they do it to maintain absolute control of the underlying asset, and for unadulterated profit. They secure an incredibly easy sale and generate interest income with zero bank friction while you get immediate access to a house. It's a dual benefit model driven equally by convenience and, let's be honest, greed.
Okay, let's shift gears to an advanced, rarely discussed architectural tactic, the overlapping mortgage. Imagine you already own a small property, but you want a much larger one, and you just lack the liquid cash. Well, you use your first property as direct collateral for the second.
You physically overlap the security instruments, so suddenly the seller has two separate, distinct assets backing their loan instead of just one. You've effectively doubled their security profile and you haven't spent a single dime of your own money to do it.
But we need to pause for a second. Stop dreaming. The perfect property, it's an absolute myth. You are not going to find a glowing neon sign anywhere that says, "Creative financing available here." Nope. You have to aggressively hunt down tired landlords and specifically locate desperate sellers who can no longer afford to maintain empty properties. You don't just magically find these lucrative deals. You forge them out of market opportunity and sheer financial desperation.
And this brings us to the ultimate strategic goal. Because the primary secret of the wealthy isn't owning everything free and clear. It's entirely about controlling the asset. By leveraging the seller's equity, using other people's money, you control a real, appreciating asset. You bypass those restrictive debt-to-income gatekeepers entirely. You systematically capture the property's appreciation over time, and your own pockets remain completely full.
So the crucial point is this: cutting out the bank does not mean cutting out your brain. Look at the required operational timeline here. Appraisal, termite inspection, home inspection, survey, an ironclad legal contract. This systematic diligence is literally your only armor. If you buy a financial disaster with zero down, well, you still own a disaster. Traditional banks force you to do this to protect their capital. But in this decentralized model, you must force yourself to do it to protect your own future.
So there you have it. The exact mechanics of this system are now totally exposed. The wealthy aggressively leverage other people's money every single day to build massive empires. The underlying question here isn't whether this financial architecture works. The question is whether you are prepared to actually use it. Stop letting an empty pocket mathematically dictate your strategy. Are you ready to hunt for that tired landlord and structure your very first zero-down deal?